Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategist. Today, I'm thrilled to be joined by Todd Sohn. He's a managing director and technical strategist with Strategas, and we're going to hit on all things markets. Todd, how are you doing today?
Hey, Ross, I'm great and always a pleasure to speak with you.
Great to talk to you as well. Really interesting market right now, has shown some resilience after kind of the banking stress, but I wouldn't say it's rallying or that impressive either. So, in kind of a mixed market, I want to ask you two things. What are you seeing from breadth? So, tech leadership has kind of returned, but I know some of the other sectors and industries underneath the hood are a bit more mixed. And then, among those industries and sectors, what is leadership and what does that tell you about the market?
Yeah, it's a great question. You hit on tech there, especially with Apple and Microsoft really boosting the indices. They're around 13%, or perhaps more of the S&P 500 right now. So definitely masking what's been some internal deterioration underneath the surface. There's only about 40% or so of stocks above their 200-day moving average right now. And it's not awful, right? If you get below 20%, then you're in really oversold territory. But it's definitely reflective of a very, very selective tape. And also one that is filled with some areas that are working like semiconductors and some areas that are struggling like financials and REITs. Now, I think going forward, because of the strength and the boost we've seen from mega cap tech, you want to keep an eye on the equally weighted S&P. This is reflective of the average stock. And that hasn't broken down quite yet here. It's very much range bound. But if you get a divergence where the cap weight S&P continues to grind higher and the equal weight S&P is still range bound or even deteriorating and weakening, that's going to cause problems down the line because it starts to bring into question the durability of any broader market rally. So keep that on your radar, the percentage of stocks over 200-day and the equal weight S&P 500. I think those are the two most important participation charts going forward. And that's for leadership. Semis act well. But then you have the banking stocks struggling to get off of their lows, REITs acting weak, and some cracks from areas such as energy or materials. So it's a very bifurcated backdrop right now. I think it's a messy tape and one that you have to be very careful tactically, given the constant data feed we're getting from different corners, whether it's the Fed or other influential voices within the market.
Yeah, absolutely. And speaks to that kind of complicated economic moment is reflected with a kind of convoluted market right now. You do a lot of great work with ETF flows and kind of reflecting how investors are voting with their dollars and showing some interesting things on sentiment and positioning. And so you released a great report, earlier this week, and I'm curious, what are the results of kind of your work in that area over the last, couple of years, really?
Yeah, definitely. And just to give it some context, it's been about a year since the Fed started its hiking cycle, right? 500 basis points worth of hikes. And that's left only 6% of equity ETFs with a positive return since that March 16th date. So very difficult backdrop. And that is being reflected in the equity flows data, especially this year. You only had about $3.5 billion of inflows in March, about $5 billion in February. That is much lower than the 20 or so billion dollar average over the last year. It's a very restrained equity inflow backdrop. And in fact, year to date and over the last 3 or 4 months as well, there's been more money going into bond funds, bond ETFs, than there are equity ETFs. That happens every once in a while during certain periods, but I think it's very reflective of that. Investors are happy going to treasury and cash-like products to sit in their 4% yields, as opposed to taking the equity risk that's involved given the volatile tape and with the banking events going on. That hasn't helped too much either. So I would expect this to continue until some of the hurdles, namely is the Fed done hiking, where inflation stands. I would expect the restrained flows to continue. And on one hand, that's good for a contrarian setup, right? If the market can move higher here, then there's plenty of room for positioning to get aggressive. But on the other, it also reflects very lackluster and skittish investor attitudes, and you eventually do need to see that demand come in for equities, ETFs in general, to work higher. I'm a little bit reminded of back in 2020, flows were very, very restrained coming off of the March 2020 lows. And until about November, once the election and vaccine news passed, that's when you saw flows really take off and went on a nice run for the equity market.
Yeah, people do like their certainty before they start putting their dollars to work, don't they? Well, Todd Sohn, okay, complicated economic moment, complicated March Madness this year. You're an avid college basketball fan. We're recording on a Thursday. Let's get some Final Four picks, and then when people watch this on Monday, they can see if you were right or not.
Well, first of all, I'm disappointed that my Syracuse Orange not involved in the tournament at all. Pretty tough year there. And as a former Big East Conference team, it's hard not to go against UConn. They've looked the best in the tournament. They've blown out opponents. I was amazed that they beat Gonzaga by 30. I think they're the favorite here, but they have been playing the best ball out of the 4 remaining teams. Florida Atlantic, I don't know much about them, but whenever you have a team that's going 34-3, I think that says something about them, no matter what conference it is. So maybe they can surprise folks and take down San Diego State. But still, I think you stick with UConn. They have looked by far the best out of any of the 4 remaining teams. And I think that's where the smart money goes to.
There you go. Stick with leadership. Stick with what's been working. Todd Sohn, thank you so much for the time. We really appreciate your insights as always and hope to talk again soon.
Great. Thanks, Ross. Appreciate it.